All right, today we are here to talk about bonds. Yes, that sleepy, sort of complicated part of your portfolio that's not very exciting and nobody goes on CNBC to breathlessly track every movement. But bonds are super important to your retirement income. And today I'll tell you about why that is and why you do need bonds in your portfolio now more than ever, really. So what's the purpose of bonds? Generally, investors viewed fixed income as a safe haven, expecting bonds to rise in value while stocks fall. And that's if they even think about bonds at all. But the fact that both declined in 2022 is pretty rare. The last time investors saw back-to-back losses like that was in the 1950s. Now, a lot of investors among the ranks of the pros really have noticed there are improved opportunities in fixed income now due to higher yields. So now is not the time to be reducing your bond exposure, in other words, selling, after last year's negative returns for fixed income. But there's a silver lining. If yields do keep rising, investors seeking higher expected returns, in other words, everybody, may be better off maintaining the duration of their fixed income allocation. Now let's pause for a minute on the term duration, which has a very specific meaning in the fixed income world. In plain English, duration means the length of time something takes, like the duration of a football game is 60 minutes or 4 quarters. Remember that Bills shirt from the other day. But in fixed income parlance, duration means the sensitivity of a bond's price to changes in interest rates. The higher a bond's duration, the more the bond's price will change when interest rates move, which means higher interest rate risk. When investors believe rates are going to increase, they generally shift to a lower duration strategy to reduce that interest rate risk in their portfolios. We've seen this time and time again when the Federal Reserve hints at a rate hike. Calculating duration isn't really something you can do at home for a fun afternoon, unless you enjoy that sort of thing, and maybe you do. I don't know. Not here to judge. Calculating duration takes into account yields, bond coupons, and the final payment upon maturity. It essentially measures how sensitive the value of future cash flows are to changes in rates going forward. As time passes, duration for a bond generally declines. So, what does all that mean for you, for your retirement, for your portfolio? Typically, you get your growth from stocks. But it looks like we're going into an era when S&P earnings are declining. Recently, Bank of America's head of equity strategy said she expects a 10% drop in earnings that will likely keep a lid on S&P 500 performance in 2023. She thinks analysts' earnings estimates are too high. She says, we're going to see those estimates come down, and it's likely to happen after companies guide more aggressively lower around 23 earnings. I think we're going to see pressures in companies with more labor intensity, like service companies, companies where you're really seeing cost pressures remain high. Those are the areas we think we're going to see some downward guidance on margins. So, be careful. Your equity portfolio may not deliver once again in 23. Not saying it's going to be a loss again like 22, but maybe only small returns. As we wrap up here today, here are some slides created by my colleague Serge Berger at Blue Marlin and Steady Trader. Here's a look at S&P 500 prices versus real earnings. This is what I mentioned a minute ago that Bank of America's chief equity strategist is concerned about. This shows you that when earnings decline, the S&P 500 tends to go into a secular bear market. But this next slide shows you the importance of stocks versus bonds right now. When you need income, and folks, that is 100% the name of the game in retirement, income. Bonds play a role there, but most people don't really understand how they fit into an investment strategy, and that is definitely something we are happy to help you with. And this slide shows you very clearly what happened for bond yields from 2021 to 2022, pretty massive increases. And finally, higher levels of inflation should prevent the Fed from easing rates aggressively, even if a recession takes hold. So there's a lot happening here that's going to affect your portfolio, which means you should take another look at fixed income. It's pretty clear. The Fed view on rates has shifted from lower for longer, which is what we saw for many, many years, to higher for longer. That means it's time to consider a new approach to your portfolio. Put your cash to work. Don't just let it sit there. If you do that, that erodes your spending power. So along with my colleagues at Blue Marlin, I believe investors can seek to generate income while maintaining the relative safety of cash-like investments through ultra short duration securities. We're happy to talk to you about that. The Federal Reserve has already delivered most of the rate increases for this hiking cycle. That means investors can look to earn a steady income stream instead of low yielding cash in your portfolio. Cash is not king. What does it do? It erodes spending power, not king. So bonds are back. During the last decade, investors largely moved away from bonds as they searched for yield in a low rate environment, but things have clearly changed. So don't miss out on the opportunities in bonds that we are seeing today and that are necessary today. I'll wrap up with some advice from dimensional fund advisors. When faced with uncertainty, investors should focus on what they can control. There's plenty of research showing us that trying to outguess the market by holding on to cash with the expectation of future yield increases may not help you achieve your long-term retirement goals. Remember, markets quickly incorporate new information about higher interest rates and inflation. Investors who maintain an appropriate asset allocation, appropriate for you, your unique situation, even after increases in bond yields, generally have a greater chance of a successful retirement income. In other words, not outliving your money. All right, thanks for watching. I know that was a lot today, but we are here to help you. I will post a link to where you can reach out to us at Blue Marlin. Thanks again.